Hi, I'm Mark Jokum, Senior Product and Investment Strategist here at GlobalX ETFs, and today I'm really excited to join our international guest, Malcolm Dawson from our New York offices. Malcolm is the head of EM Equity Strategy for GlobalX ETFs and our broader parent company, Mirae Asset. Malcolm, thank you so much for being here.
Thanks for having me, Mark. Happy to be here.
Now today, really exciting, we're going to get into a very exciting topic that is very topical for 2025, and it's really talking about one of the best structural opportunities that we're seeing in global markets at the moment, and that's covering emerging markets and particularly how you can put that in your portfolio. So Malcolm, let's first start, we're talking about broadly emerging markets. We've seen quite a bit of underperformance since the GFC, declining margins and earnings relative to developed markets. I guess the question is, what do you see as some of the key drivers for emerging markets leading into 2025?
A good question, Mark. And there's so much going on in emerging markets. 27 different countries, political systems, economies, currencies, and much more. Sometimes it's easy to get a little lost in the weeds in what's happening within the asset class. But if you really want to dumb it down, you can bring the key drivers of emerging markets into three individual bullets. The first is the US dollar. So there is a direct inverse relationship between the strength of the US dollar and the direction of emerging market equities. Historically, that's been an inverse relationship of about 3.5%. The dollar gets 1% weaker, emerging market equities move up about 3.5%. The other has to do with monetary policy coming out of the US. Now, a lot of people believe that, okay, buy risk-on assets, and that includes emerging markets as the Fed is cutting. What really happens is there's a bit of a delay period. So you have to kind of wait till the end of a cutting cycle, and then you start seeing the positive earnings revisions going into emerging markets. So looking at the past 25 years or so, following the end of the Fed rate cutting cycle, in the following 6 months and following 12 months, emerging market equities have outperformed the NASDAQ, the S&P, small caps, international equities, and various other asset classes. So that's an interesting place to be in, especially as there are a lot of questions around what the Fed's going to do next. And then last is China. China still represents about a quarter of emerging market equities. So China's super undervalued right now. There's a lot of stimulus coming on. I think it's a bit of a contrarian trade. But if people think that there might be some bright prospects from China, that could be a well-aligned star for EM as an asset class as well.
And Malcolm, you mentioned around China, and I guess there's a lot of different diverging trajectories within emerging markets. Out of all the emerging market countries, and you said there's quite a lot of them, what do you see as the best long-term opportunity right now in emerging markets?
You know, I think one thing also interesting to say, we've mentioned EM as an asset class has underperformed the past decade or so, but in every single year over the past 15 years, an emerging or frontier country has been the best performing market in the world. And then if you look at it from a more like 3 to 4 year basis, India has just stood out as a compounding machine, showing some of the best risk-adjusted returns in the world, and we think that that's set to continue. And that's one of the reasons we love India as a long-term compounding story, is that it's sort of EM light in a way. It has low beta towards EM and low beta towards developed markets, inverse relationship with commodities as it's an importer of energy, and it's a strong domestic structural story. Best demographics in the world, we believe, a strong government, pro-market government that's implementing some real significant market-friendly reforms. And third, there are a lot of question marks about what's happening in China right now, and India's the key beneficiary to do well in terms of China's headwinds.
So Malcolm, final question to you. For Australian investors positioning in global equities this year, there's a few ways that people can position in developed versus emerging markets. How should people be thinking about incorporating emerging markets into their portfolios, not just for 2025, but also beyond as well?
For sure. And I think we could break it down in a few ways, but starting out with that, just say add some, because there are too many advisors and prospects that we speak with that have little to no exposure to the asset class at all. And we think that when you look at how strong the dollar has been, where we are in terms of a monetary policy cycle, and the margin of safety you have in terms of valuations, return profiles, and growth prospects out of emerging markets, it almost feels a little irresponsible to not have any exposure at all. So we think that adding exposure can improve your risk-adjusted returns, it can improve your broad diversification, and act as a US dollar hedge if the dollar was to weaken. Second of all, in terms of size, that really depends on your risk profile and your timeline. But what we see is, emerging markets make up about 24-25% of global market cap. If If you look at the broad indexes, they represent about 10 or 11%. But most advisors that we speak with have about 5 to 7% exposure. We think that one should probably be at least in line with the indexes at around 10%, but there's a lot of arguments, many arguments to be made to add more, especially when you think about global GDP, 50% of that's made up of emerging markets. Population, about 85%, land mass around that number as well. So really big opportunities there. And then I think the last thing I'd say is, how do you do it? Because a lot of people, we mentioned there are a lot of different factors going into emerging markets. A lot of people don't want to have that significant amount of exposure to China, which represents about 25% of the asset class. So more and more, we're seeing people either kind of build their own emerging market portfolios on a country by country basis, or a lot of people, I mentioned India as being my preferred long-term structural pick. A lot of people are just using India as a placeholder for their broad emerging markets exposure. And we think that that works because in a way, it's your ideal emerging markets. When you see the demographics, the market-friendly reforms, and just the prospects for growth, it's got everything you need.
That's great. Malcolm, thank you so much for your time today. Very interesting to hear about the outlook for emerging markets and where the best structural opportunities are going into 2025. So thank you very much for joining us.
Thanks for having me, Mark.